Chapter 8 is on the theoretical aspects of corporate governance. In academia, most of the time, the positions that we take must be supported by what is known as theory. All right. So some scholars might have said something that we think makes a lot of sense. And it's not something they have just said, but they have actually, it has been practiced and found out that whatever they said is something that really is applicable or true to real life situations. Then they become a theory. All right. So we'll be looking at agency theory, stewardship theory, shareholder versus stakeholder approaches. We've already kind of hinted on this already. Stakeholder theory, then other theoretical perspectives. Then we'll look at ethics theories and corporate governance, just to emphasize the connection between corporate governance and ethics. The fact that, yeah, the two actually moves together. So yes, so theories underpin most of the positions that we take, and the theories that govern how the notions and the positions in corporate governance have come from different disciplines and backgrounds. All right, some have their origins in finance, economics, accounting, law, management, organizational behavior, and all that. So if you've paid attention to our discussion, sometimes we are talking about financial statements. Sometimes we are talking about debt financing. We are talking law. We are talking about how to manage your business. We are talking about how to relate with employees and things like that. So corporate governance really draws from several disciplines. All right. When it comes to proper governance of organizations, you need all these disciplines on board. Knowledge of these disciplines on board for you to be able to be effective. Okay, so let's look at the first theory. The first theory. We relied on the first theory a lot to be able to explain the introductory part, the lecture we just finished on the overview of corporate governance. Okay, so the agency theory identifies the agency relationship where the principal, that is the company's owners, delegate decision-making authority to the agent, which is the company's management. The theory assumes that the interests of a principal and an agent are not always in alignment. Okay, so that is what is known as the agency problem. I explained earlier that those that invest their monies in the company, loosely referred to as the owners of the company, most of the times are different from those that are engaged in the day-to-day management of the company. Okay, then that creates the agency problem because there is a tendency that the agents or the management will not act in the best interest of the shareholders of the company. Okay, so the expense incurred due to such objective dissonances refers to as the agency cost. In order to minimize or prevent agency problem, you'll necessarily have to incur a cost that is known as agency cost. In the earlier explanation, we said you needed boards to be able to regulate and supervise the way management undertake the activities in order not to abuse the interests of shareholders. And getting boards on board is not for free. Okay. We've also made some discussions on the rooms that they take and the kind of the amounts that they are normally paid for having boards in a company. So it is not for free if you want to address the agency problem. The agency problem comes with what is known as the agency cost. Okay, you need to pay your board of directors. And even ordinary, most pharmacies now, if you go, you'll see that they have CCTV cameras. In fact, not just the hotels, most businesses. Okay, sometimes it's not just because they are afraid of theft from external people. It is meant to also regulate the employees of the companies to see how they are operating. All of this feed into what is known as the agency cost, because the actual owners cannot be there for the day-to-day management of the business. All right. Okay. So the main thrust of this theory, agency theory, is that there are two main methods for lowering agency expenses, which include fair and accurate financial disclosures. All right. So in order to lower agency cost or agency problem, the expense here is used to show how much it will cost you if you were a principal and you have to rely on an agent. Okay. So the best way to reduce agency costs, not agency costs, agency problem. Sorry, I want you to get it well. To minimize agency problem in terms of the expense that you have to bear because it's an agent that is operating on your behalf, is to ensure, number one, that there is fair and accurate financial disclosure. All right. So all this talk about keeping of financial statements, about auditing of financial statement, about giving accountability is have their roots from the agency theory. Okay. So it called for having fair and accurate financial disclosure. So basically what the theory is saying is that, yes, as a principal or owner of a company, you might not be able to be there for the day-to-day operations of the company. But one of the ways by which you can minimize the abuse of your resources is to make sure that the agents keep fair and accurate financial disclosures in terms of the financial statements and financial records that will be kept in the organization. Okay. Then the next point is to have an efficient and independent board of directors. I think the whole of this morning we've been talking about this. All right. So having boards of directors is part of the cardinal advocate of agency theory. All right. As one of the ways to minimize the agency problem. You might not be able to be there day to day as an owner, but you can have an efficient and independent board of directors. And these two descriptives are not just mere words, all right? The board must be efficient. It comes with a cost, but you have to find a way to minimize the cost that comes with having a board. You don't have to spend all your money. Otherwise, what you are afraid will even happen through the honorariums and the allowances that you pay into the board. So it should be efficient in terms of how much they are paid and their use and so on and so forth. But they also have to be independent. And here also we've spoken about this. You don't want a board that will just come and be saying yes to whatever management is saying or saying yes to what you will be saying. If it is the case that you are also part of management and owner at the same time. All right. You need a board that will be independent minded to be able to give their critical suggestions and views when things are not being done right. Okay. So these two have their roots in agency theory. And the argument of the agency theory is that there is some form of mistrust of the agent. The agent has the tendency of abusing the resources of the principal. And therefore, there are needs for checks and balances to ensure that that tendency is kept or reduced to the barest minimum. Okay. I hope this is clear. Then we'll move to our next theory. The next theory is almost the opposite of the agency theory. Okay. And it's known as the stewardship theory. So it argues that managers can be regarded or should be regarded as stewards of the company's assets and will be predisposed to act in the best interest of the shareholder or shareholders. Okay, so unlike agency theory that sees management as agents, stewardship theory sees management as stewards. And the words are not the same and in whatever, in our use of them. Okay. Agents are almost like hirelings, people that have been hired to do their job. They are simply there to do their job. They don't have the principle at heart. They are basically there to do whatever they have been asked to do. Stewardship has a different connotation. It is where the person who, even though an agent, he has the principle at heart and is prepared to even die, in quotes, to protect the interests of the principal. So stewards tend to have different motives in terms of how they operate and how they deal with their principal's assets and property. Okay, so that is the difference between these two theories. One assumes that if the principal gets opportunity, they will misuse or take advantage of the principal. The other assumes that the steward or the agent will have the principal, who here is referred to as the steward, will have the principal at heart and therefore will not unduly take advantage of the principal or the owners of the business. Mami say, why your hand is up?
Please, in terms of accountability, do they all account?
Account for their stewardship. So
Yes.
that's where I'm coming to. Okay, so you just pay attention. I'll explain that. So, so you realize that in the first instance, we spoke about having financial disclosures, and that means having financial statements, having the statements audited, coming to give an account. Okay. When it comes to stewardship theory, the argument that have been explained here, managers are not motivated by personal goals, but rather as stewards align their motives with the motives of their principals. So under this theory, managers are supposed to be viewed as stewards, and stewards don't normally pursue their personal goals, but whatever they are doing is normally in the interest of their principals. Point two, given a choice between self-serving and pro-organizational behavior, a steward's behavior will not depart from the interest of the organization. So if you assume that management, okay, let me pick the last one, then explain all of them together. Control can be potentially counterproductive. So according to this theory, because the steward will have the principle at heart, and if it's torn between choosing something for his personal interest or for the organizational interest, may decide to go for the organizational interest. It is actually counterproductive or waste of organizational resources to be putting in place mechanisms to check and control the operations of management. Okay, so unlike the first theory that advocates the need for financial disclosures, financial statement preparations, auditing, having independent board of directors, efficient and independent board of directors, this theory actually says that if you spend a lot of money on having boards and preparing whatever, employing auditors to come and check, all of those things will be actually waste of resources, because stewards are not people that will take advantage of their principals. Okay, they are most likely to be able to work in the best interest of their principals. So the theories are almost in the opposing views. All right. So back to my Mr. West question. Whilst agency theory is putting in place stringent measures to ensure accountability, all right, from the perspective from managers, stewardship theory says, yeah, you can come and give an account, but it shouldn't be under strict scrutiny as if we don't trust you. All right, we should allow you to operate the way you want. At the end of the year, you may still come and give an account of your stewardship. Any way that you explain it, because the theory principally thinks you will not be somebody who abuse the interest of your principal. We can trust whatever you say. Okay. The other theory says no. Once you are an agent, you have self-interest, and it's very possible that you can abuse the resources of your principal. And yes, you have to give an account, but before even the day of the accountability, we have to put in place mechanisms to ensure that you're doing the right thing even before the day of accountability comes. Okay. So in both cases, you may be giving an account, but the strictness with which you have to give account differs. Agency theory, very strict. In fact, as I said, before the day of accountability, they are on your neck to make sure that the right things are done because we can't trust you. That's basically what the theory is saying. Okay, stewardship theory, you are a steward and we trust you. So yes, come and give an account, but we will not be monitoring you strictly as we will have done if we considered you as an agent.
And so stewardship is basically established when there's trust.
That's right. So that is what the theory is arguing for. Okay, so just a general explanation
so
of
it's
how.
just a theory, but it's not applicable.
Listen to me first. Okay, so I'm coming there. So when it comes to theories have their criticisms and they have their whatever. So the fact that it's a theory doesn't mean that is what you should be applying. But we basically have to learn the theories and see the positions of various scholars as to how companies should be governed. Okay. So as you can see, in reality, nobody buys into the stewardship theory. All right. Because even your own son, even yourself, we just spoke about the fact that even some CEOs can abuse the resources of companies that they have founded. All right. But we have to know these positions because there are two theories that are advancing the position as far as corporate governance is concerned. Okay. So theories are generally like that. They are positions that are held by scholars. They tend to have their benefits or advantages and they have their disadvantages. Normally what happens in practice may be a mixture of these theories or a complete rejection of some theories in favor of others and so on and so forth. Okay. Right. We've spoken about this also, shareholder versus stakeholder approaches. When we're defining corporate governance, we had Milton, Milton what? Is it Friedman? Then we have the public policy approach, okay? So Milton's position was more of the shareholder approach, all right? So companies have a small number of obligations. One, maximization of shareholder value, and two, compliance with the law. Besides this, everything shouldn't be the border of a company. That is what is meant by the shareholder approach. The company should exist to maximize the interest or the value of shareholders. And in doing so, they have to comply with the law. All right. The stakeholder approach of corporate governance, these two are not necessarily theories, okay, but they give us the perspective that people would take when it comes to governing companies. All right. Even though we have stakeholder theory, that leans surely on stakeholder approach. Okay. But stakeholder approach is just an approach. So the other one is where companies have obligations to other parties like employees, government, media, other than shareholders. So beside your shareholders, we have other interest groups that we have to be mindful of if we want to govern company properly. All right. So good. So there comes the stakeholder theory. And as I indicated earlier, it had its root from the stakeholder approach to managing or governing companies. The fact that as management, you shouldn't only be thinking about how to satisfy the interest of your shareholders, but the other stakeholders or the other parties that are interested in the affairs of the company. And the main trust is that every organization or companies are based on input-output model. Okay, however successful you've become is based on this model. You've taken raw materials from society, the labor is from society, the finances are from society, and so on, to be able to produce your goods and services. In fact, even after you've produced the output, you need society to be buy those outputs in the form of customers and consumers and other organizations. Okay, so at the end of the day, it is not just about you. You need society. And that implies that whenever you're doing something, you don't only have to be interested in the financiers or the shareholders, but you need to be interested in all the stakeholders that play a role, either in the form of your input or output, whenever you're taking decision as a business organization. Okay. So you must incorporate all interest groups, including employees, consumers, dealers, the government, and society as a whole. So that is the position of the stakeholder theory. All right. Good governance means that paying attention to the interest of all interest groups and not just that of your shareholders. Okay. So there are some, as I said much earlier, all the theories. Okay, and if you get the book, you'll come to appreciate that. So almost every theory will have its positives and negatives. The criticism of the stakeholder theory is, point one, who exactly make up a true stakeholder? So much earlier, I think from Blessling's question, I explained the distinction between primary and secondary stakeholders. And this question is coming because, as I also indicated much earlier, there is the tendency for management to rely on this theory and waste the resources of the company. Because literally, you can argue that everybody is a stakeholder of the company if you want to stretch it that wide. And if that is allowed, what it means is that businesses can just waste resources anyhow. Okay. For example, they can go to funeral donations, right? And in society, I'm going to be giving money. Okay. If there were questions, they will say, oh, they used to buy, or there are people that use our company products. Okay. If somebody is doing an outdooring, they can go and sponsor and pay for the outdoor, anything at all from society, and they can find justification for that. So that is where that thing is coming from. Look at the second point. The theory is criticized for opening up a path to corruption. All right. So if they are allowed to make donations to funerals, which type of funerals will they be making donations to, and which ones wouldn't they be making donations to? Okay. And how much should they even be making if they are permitted to make donations for funerals and outdooring and all that? And I'm using this because of the society in which we find ourselves, right? Where we value this kind of things. So the meaning of who a stakeholder is by itself is something that is not clear. And as I indicated, most times, even for it to make sense, you have to limit yourself only to your primary stakeholders. Because if you want to stretch it, almost everybody, including the media, pressure groups, depend upon the organization in which you find yourself. All right. Okay. So some critics also refer to the theory as being superfluous. So really, it's coming from the criticism of who our stakeholder is. They are so broad that, in fact, that theory doesn't even deserve to exist because we can't pinpoint who our stakeholders really are if we want to stretch it. Blessing, I've seen your hand again. I can see you have interest in stakeholder issues. Blessing. Hello.
Okay. Corporate bodies have.
Sorry, your line is breaking. We can't hear you.
Specific obligations or hello?
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 Yeah, it's clear now. Can you start?
Wow. Hello?
Yeah, we can hear you now. Can you start?
Okay. So I was saying that, all right, that's fine. So please, my question is this. I thought the obligation that corporate bodies have towards stakeholders are specific in terms of what exactly you have as a responsibility to maybe your customers, your creditors, your employees. And so with the criticism, how would you be giving donation to your customers for funerals, like, and then kind of validate that as a point. I'm not getting this clearly.
Okay, so the point I was trying to make is that in terms of the specifics, there are no written stuff, okay, as to when it comes to customers do this, when it comes to that, do that. It is most times discretionary to the management of the company. That is why I think one point we explained the fact that whether investors should come on board or shareholders should come on board in making that particular type of decision.
When it comes to PRS.
Yes.
Okay.
Okay, because
Yes.
it's an area where management have the discretion to make. In practice, however, what normally happens is that management will be looking at places where they can get what is known as tax exemptions. Okay, there are some activities that are promoted by the government. And if you go to the tax laws, they will show you that if you were to do this, maybe it's tax deductible. You can take it out of your whatever before you pay your tax and so on and so forth. So most organizations will be looking at expenses that are tax deductible, because that then will help them to minimize their tax obligations to the state. Okay. Yes. So I just use that example to at the extreme level for you to appreciate that because of the discretion that they have, they may choose to even go into funeral donations. I'm not saying
that.
exactly. Okay. So
yes.
I'm not saying that is what they normally do, but that could happen if we just leave it up like that. I hope it's clear now. Blessing,
yes, please.
fine now. Okay, that's fine. Any
yes,
other
please.
question?
Yeah.
That's okay. Any other question? Okay. So let's move to the other theory. It's known as sociological theory. Okay, so this theory looks at board composition and its implication for the distribution of power and wealth in society. All right, so this has its roots in feminism, advocacy, and gender advocacy and stuff like that, even though it goes beyond that. But principally, it's about the protection of minority groups. Okay, when it comes to board composition, it's about power, because the board gets to monitor how businesses make decisions. So all this board diversity is moving towards where the argument is that in order for you to have a board that will function well, make it more representative of society, i.e., it should include, say, females, all right? If you have some minority interests, much earlier we spoke of minority shareholders, find a way to represent them on your boards. If it is something that will have implications on some sections of society, make sure such persons are also on the board of the company or the institution or the organization, okay? Because it's about power and it's about wealth. It's about how companies are supposed to be governed. So if you have all the board members being, say, male, the argument, if you even take away the decisions and just limit it to the honorariums and the sitting allowances, what it means is that you're going to empower more of male relative to female, all right? But it goes beyond that. It goes beyond decisions, as we've explained earlier, when it comes to CSR. If you have all male, there is the higher tendency that maybe when it comes to those discretionary areas, the decisions will not favor females in society, all right? If you don't have people with some special needs, if that is what the company is about, and they are not on the board, what it means is that you will not even know what they need and therefore how to address those needs, okay? So that is the argument from sociological theory. Boards must represent society as much as possible. And what means is that it should represent the diversity of interests that we have in society. Because at the end of the day, companies and businesses are basically about the distribution of power and wealth in society. Is the theory clear? Is it clear?
Please come again.
So the theory, sociological theory, within the context of corporate governance, lays emphasis on board composition. I think later on we'll be looking at the concept of board diversity. Okay, that is where it is coming from. The fact that you need to have a diverse board. Okay, and the logic is that when it comes to companies and businesses as a whole, it's about the distribution of power and wealth in society. All right. So if you have the board being only female, the higher tendency is that they will make decisions that will favor only female in society. That will be at the disadvantage of males. If you have a board that is only male, what it means is that they are likely to make decisions that will favor only males, and that will be at the disadvantage of females. All right. So that is just one of the diversities. It could cut across depending upon the type of organization that you are dealing with. Okay. So the board should be composed in such a way that the various interest group of society, and here we are not talking about society in totality. We are talking about society in the context of the type of company that we are dealing with. The interest group must be there because it's about the distribution of power and wealth. And most of the time, as I said, it has its roots in feminism and gender advocacy, where women or females are arguing that businesses are male dominated. Okay. They don't get to be on boards. They don't get to become CEOs and so on and so forth. So for businesses to be governed well, or to ensure that companies are governed well, they must reflect society and make sure that all the minority groups, and here to make it more easy to understand, we can use that to mean the female must be represented on board in order to advocate for the interests of females. Okay. I say, well, I can see you.
Please, are you talking about the board or the company? You know, there are some companies that require more men than the women in terms of the job that they are offering.
No, I'm talking about board composition.
The board.
Yes.
Okay.
Yes.
Okay.
Board. And you know, the board can, yes, so that is where all these things coming from. Based on how the board is structured, they can even influence the number of males that they have in the company and the number of females that they have in the company. Okay. But within this context, we are talking about the board composition. Okay. Right. Is it clear? The rest of you guys?
Yes, it's clear.
It's clear, right? Okay. Then let's move to our next theory, known as resource dependency theory. Okay. So this theory is actually coming from strategic management. All right. And it argues that organizations rely on resources outside of the organization, the external environment, in order for it to function properly. Okay, and board of directors are viewed to be one of the crucial resources that a company needs in order to be able to function properly. Okay, is that point clear? So this resource dependency theory is actually advocating for the needs for boards. Just as we had under agency theory, the only theory that didn't advocate for the relevance of boards was which type of theory? I want a response from you guys. So far, which theory is actually against the presence of boards in organizations?
Stakeholders.
Stakeholders. Are you sure? Are you sure stakeholder theory? Have you forgotten about? Hey, Ma'am, why you are just guessing?
Yes.
You've forgotten about stewardship.
The third one. Yes,
So
I
how
mean
I explain
stewardship.
it?
I mean there's stewardship, but I didn't know how to. I just forgot about the name.
You
As I said,
in exams too, when you submit your paper, you come back. You come back and
hey,
come.
prof, no.
No, I'm always telling you, yeah.
The
Okay, you let's
explanation is
continue.
there.
Yes. So you can see that so far it is only the stewardship theory. It actually argues that having boards is actually a waste of resources because your managers are stewards. Okay. Almost all the other theories, either directly or indirectly, they are advocating for the need for board of directors. All right. And one of such theories is the resource dependency theory. So the theory says that directors are critical resource that the company needs in order to be successful. Have you guys, or will you guys be doing strategic management? Have you done it already, or you are yet to do it?
I think we did it during the undergrad, but I don't know if we'll be doing it again. Masters.
Okay. I think it should be part of public policy. Maybe. All right. But that's just
maybe next semester.
right. So the theory classified directors as inside. So generally, they are important resource that will help a company to perform well. So the theory sees directors as insiders. Insiders in this context doesn't mean they are employees of the company. What they mean by insiders are that these are people that will normally have a better understanding of the industry. Okay. So if you are, say, a bank and you want to form boards, all things being equal, you need to have people that have experience with the banking industry. Okay, so to be able to provide you more insight into that particular industry. So that is where insiders is coming from. All right. So they are insiders. They are normally people with expertise in the type of industry that you're going to deal with. Okay. They are business experts. So that is basically that. So if you take business generally, these guys are people that should be people that understand how businesses are governed and regulated and so on and so forth. Okay. They are support specialists. So sometimes some people may not be, they may not have the first two. They may not have been in the industry or business expert, but they are specialists. For example, you cannot do away with, say, having a lawyer on your board because he might not be a business person. He might not have managed a business before, but generally business is about rules and regulations and laws and their conformance. Okay. So they normally are people with expertise and they are specialized in a particular area. All right. And all of you guys after this course, you can be on boards, right? Not because you say you have managed a company before, but even to guide the board itself as to how they should do their activities. I wasn't talking to you. I don't want to.
Question.
Even how to guide businesses. You realize that the knowledge you are getting is very valuable, and only a few percentage of people in the population have this. Okay. So you can have people like you on board to be support specialists. So that is how some directors on boards, the role they play. Okay. Then you can have the community influentials. All right. And I think somebody touched on this much earlier. There are people that can pull in investors, that can get people to buy into the company's vision and so on and so forth. So you need such guys on board as well. But the only thing is that they should have some knowledge in whatever that they are doing. Okay. So these boards come with this advantage because they have all these diverse things bringing on board to help the company to be properly governed. Okay.
Prof, just to clarify something, I don't know how true it is, but I heard that when you study law, as in company law, those kind of laws, you can be part of a board. You can be a board secretary. I don't know how true it is. Is it true?
So your question, is it board secretary or board?
Yes, yes, board
Which of
secretary. So
them?
it'll be part of the board.
So board secretary is an executive position. It's not your usual understanding of a secretary, somebody who takes minutes and during meetings. No, board secretary is a specialized position, and normally because of the legalities involved, lawyers normally tend to be secretaries of boards. Okay, even though there is a professional company secretary course that you take, but get the understanding that board secretary doesn't mean the usual typist or secretary who takes minutes. No, it's a legal position. They take all manner of law things. The agenda, yes, some of the things are related to agenda, minutes, but it goes way beyond that, okay? So they require people with knowledge in law before you can
Yes. So the person was like, if you've studied law for 5 semesters.
So I'm coming to all of that. So you just pay attention. Okay. So if you have a law background, it positions you well to become the company secretary. In practice, for big companies, it's not just an individual. Sometimes it's a whole law firm that is the secretary of the company. Okay. So the whole firm, law firm, operates like the company secretary for that particular company. As I said, they are legality. So it's not your usual secretary understanding that role that they play when you are a company secretary. Okay. And much earlier, so back to the next explanation, I think you joined late, but I told you that based on the new Companies Act, is it Companies Act or Banking Act? One of them, I think it's Company Act. You need a tertiary level qualification or knowledge, taking a course in corporate governance before you can become a member of a board. Okay, and I gave my reasons. It's coming from the banking crisis. The fact that Bank of Ghana and other regulatory bodies realize that most people that are on boards right now don't know anything about corporate governance. They may have knowledge about other things, but they have no idea what corporate governance is about. Okay, and it's very, very true. If you finish with this course, your knowledge level will just jump like that. Okay. So it's, and the other requirements now in order to qualify for a board. But what I know of is boards on banks. Okay, when it comes to the banking sector, until you have taken a tertiary level course in corporate governance, you cannot be appointed as a board of a bank. All right. But we are in Ghana, whether this provision will be complied with or not is another matter altogether. All right. So the main thrust of this story is that board of directors are very, very crucial resources that every company needs to be able to function well. Okay. Then we have another theory that talks about transaction cost theory. So according to this theory, the organization has a reasonable, efficient hierarchical structure that acts as a foundation for managing its contractual ties. So similar to stewardship theory, this transaction cost theory is somewhat against having board of directors. The argument of the theory is that if you have good structures within the organization, the internal controls within the organization should be enough to ensure that the company is properly managed. Okay, you don't need external bodies like board of directors, and that it will be a waste of time, or not time, but resources. It will be cost to the organization to be employing third parties, to be monitoring the contracts and so on and so forth of organizations. And that the internal structures of the organization, if they are well structured, should be able to ensure that companies are properly managed. So close to stewardship theory, in terms of their main thrust, the transaction cost theory does not support the presence or the need for board of directors in the governance of companies. Okay, right. Let's move to moral hazard theory. That theory is very close to agency theory, all right? Because both of them don't believe management. They don't have any trust in management. And obviously, if that is the case, then that theory will be advocating for the need to have good structures in place in terms of board of directors and so on and so forth. So the theory describes managers, moral hazard describes managers' opportunistic behavior. So if they get a chance, they will not spare the resources of the organization. Okay, it argues that managers exhibit opportunistic behavior by making decisions that are not always in line with shareholders' interest. All right. So the theory, in fact, is agency theory is either is embedded in agency theory or agency theory is embedded in it. Okay. They are closely related. So it says if you leave the manager, he is likely to take advantage of the shareholder. And therefore, there is moral hazard. You cannot trust the manager. And therefore, there must be some structures in place to make sure that doesn't happen. Okay. Then we have the political theory of governance. Much earlier, we spoke about the fact that one of the responsibilities of the companies is to make sure they are politically non-aligned. And I said that point is particularly important in our country, okay, because we've seen how otherwise successful businesses have gone down because the perceived owners were perceived to be linked to a particular political party and so on and so forth. So if you want to do business, let it be strictly business. If you want to be a politician, let it be strictly politics. But in the same breath, I told you that you need to appreciate the influence of politics in business. And I was talking about even the awarding of contracts and so on and so forth. So don't be a politically active, but don't also undermine or underrate their political influence. And that is where political theory is coming from. All right. So the recent DDEP, domestic debt, exchange program, is a classic example of that. All right. Where government is basically slashing the interest rate that they agreed on with customers. It's purely a breach of contract in legal terms. All right. Nobody forced you. You said you wanted money. You said you were going to pay interest of 20% or whatever percent. Then all of a sudden, as a result of how you manage your economy, I don't want to say badly or poorly, you've come back to slash the interest to rates, I think is 9% or 10%, right? Yeah. And then initially, for me, what disturbs me about the whole DDEP is the idea of the finance minister even going to the attorney general with the mindset of forcing or literally seizing the property in terms of the investments of bondholders. All right. I don't know whether you read the advice of the attorney general then to the finance minister. Okay. You can look at the Constitution of Ghana, the fact that people's property are sacred to them. People have toiled and labored with their whatever. And you had the mindset of just seizing this asset. If it was possible, you wanted the attorney general to give the approval to that so that you can just withhold onto the investments that people have made. Okay, but back to my point. You see, then later, based on the advice, they made it voluntary. When it became voluntary, individual investors, some had the courage not to sign up for that particular program. And up to now, substantial people, individuals have not signed up onto the program. In fact, recently, I think they did a second one and it closed. The deadline was yesterday or so. Okay. But almost all the banks had to sign up for this particular program. I'm talking in the context of political influence. It may appear voluntary, but you know what the government of the day can do if you fail to sign up. If it was just individuals like us, you can choose not to sign up and there may not be any serious consequences. But if you are a bank manager, an astute bank manager, you will know that even though there is the word voluntary there, it is actually involuntary. And in the interest of your own business, it is better for you to sign up. Okay. So the political theory basically argues that if you want to manage businesses well, don't underplay or downplay the influence of political authorities, those that wield political power. Okay, because there are decisions. One decision can lead to the collapse of your business and the company. All right. So they may not like it. They may not have signed up if they had their own way, but those who understand the political theory and the governance of businesses will know that you always have to recognize the power of politics or political influence in the management of business organizations. All right. I think much earlier, I was talking about even the debt. No, not debt. This banking sector, was it recapitalization that led to the closure of several local banks? All right. So behind the scenes, there are all manner of rumors that are going on. Okay. The political reasons why that particular decision was taken. On the surface, it might appear as though they want to make the banking sector stronger. But other people hold a strong view that it's just because they were targeting political enemies. All right. I don't know how true it is, but in the context of political theory, it is something that if you're an astute manager of a business, you want to be mindful of. Okay. You cannot just say, oh, I don't care about politicians. I don't care about their politics. No, you get yourself into trouble. Okay. Then ethics theories and corporate governance. So once again, whenever we mention ethics, Blessling's name just jumped at me. All right. So once again, we're seeing the connections between all the things that we've learned under ethics and corporate governance. All right. Yes. If you're a good person, that is virtue ethics theory, isn't it? Then we can assume that if you also become a good manager, you'll be able to govern the company well. So there is some connection between the theories in ethics and good or proper corporate governance. All right. On this note, yeah, thank you.